All right, good morning, everybody. So we made it to the end of the week. The uh, the FOMC went reasonably well. President is tweeting this morning that he has made his decision on the new Fed chair. Markets are kind of reacting to that. They started to react to it yesterday afternoon, and he hadn't named the person yet. He had just said he made his decision. Markets responded. This morning he named that decision. Now we're seeing things kind of turn back the other way. Small caps are down the most, with the Nasdaq right behind it, then the Dow, then the S&P, uh, down around 0.5%. The rest of the world green. Europe doing the best, but it is starting to pair that, right? Everything's starting to turn back around. If we look at what we have on the table today, PPI is the biggest thing that we're going to get today. This 130 Fed here, this is nothing. It's like talking at a college or something. That's not a big deal. The interview poses a bigger threat. So this 1 p.m. Stephen Moran interview, simply because they can run gotcha moments, or he can do foot and mouth. There's just so many ways for something like that to go wrong. So be careful with that one. Otherwise, really, once we get through the PMI at 9:45, we're pretty much good to go for the afternoon. The numbers, they're really not out of line, so not expecting the market to react too much. And it does sound like we may have averted a government shutdown, possibly, but we still need to see it play out. I believe the House said they wouldn't be back in time to do the vote. So even if an agreement is reached, they can't get enough people back in time to get the vote. So there could be a very small shutdown, a few days, and then we get opened back up again. I've seen this headline come through. Money markets are wagering on more than two 25 basis point rate cuts this year. This is something that I've been trying to get you guys to understand more often. The guys that's been around for a long time, you get it. But if you see that kind of headline and you're newer to trading and you're trying to figure out what the hell they're talking about or how you can see it, how you can keep track of it, it's this FedWatch tool, right? So all you got to do is just go to Google, type in FedWatch, and you can find the CME group FedWatch. It's free. You don't need an account. You don't even need to log in, right? You just go there and check it out. It's free, right? So up at the top, you've got all of the meetings for the year, and then you can just poke around through the different meeting dates and see what the market is doing. Are they pricing in a cut? Are they unwinding what they had priced in? That's where you can see it, right? So that's what their projections are. That's not what the Fed's projection is. That's what traders are hearing, what their interpretation is of the Fed's current stance. So if we get any data or news or headlines that makes the market think that this is no longer accurate, then they'll start to make changes, and you can see those changes here. You don't have to wait for a headline to come out and tell you. Kevin Warsh is the nomination. We'll see how it goes. Back when Powell was elected the first time, it was a run between Warsh and Powell back then, and they chose Powell over Warsh. So this time, going the other way. Looking at the president's schedule today, or things that could come out of the White House, we're looking at a low risk or a moderate risk, all things considered. Probably because, they already hit us with the biggest news that they could hit us with today. The charts that I use as we cycle through all of these on Thinkorswim, I've built a lot of these for TradingView as well, the ones that don't require options data anyways. And you can find the links for these charts, whether they're on Thinkorswim or TradingView, in the description of the YouTube video for this morning briefing. So if you want the charts, head over to YouTube, scroll down into the description of the live stream, and you'll find the chart links. While you're there, help me out. I'm trying to grow that channel out this year. I've been running these morning briefings for years. I've never really had any interest in growing that channel out, but someone kind of put me on the spot, gave me a bit of a challenge, and I thought, well, why not? Let's do it. So help me out, like and subscribe the video, share it with your friends, make comments on the videos, do all the things that make the YouTube algorithm um, push the video up a little bit higher, and get yourself some charts while you're at it. Overnight participation at 128. We've been seeing, a higher than average overnight volume for the week. Generally, mid 50s is what we would expect, like we had on Tuesday. But Wednesday, Thursday, and now into today, it's just been elevated overnight volumes. It's not a bad thing or a good thing. It just shows participation. I use this mainly as a tell that maybe I missed something, right? There's nations that are trading around the world, and me being the typical American, I don't pay attention to other nations' holidays. So one of the easiest ways to see that something is off, maybe Europe didn't open for a banking holiday, or China was closed for a holiday. Rather than trying to keep track of everybody else's holidays, just look at the volume. If I come in the morning and the volume is way off, I know something is wrong. I go check around and see, was a nation closed, or was it something else? Maybe the markets are sitting out because they know some event is about to happen. I've had that as a really nice heads up early warning. We usually know, right? CPI, PPI, non-farm payrolls is pretty obvious. But sometimes it's things that aren't so easily scheduled, like when we do QRA. All of the news sites are getting much better about reporting when we have QRA, but for years we would run through that QRA event and you wouldn't see it scheduled anywhere, right? We're talking about the quarterly refunding announcement, which is a two-part announcement. You get one on a Monday, and then 2 days later on Wednesday you get the other part. On Monday it's in the afternoon, like 3 o'clock, and on Wednesday it's early in the morning, 8:30. But if you didn't know that was coming, and there's no mention of it in the economic calendars, then you wouldn't understand why the volume was so light. But the light volume would give you a heads up that something was wrong, something was up, because they were sitting out waiting for something. So that's why I still use it. You never know what's going on out there that you might have missed. And if you come in and find a really light volume, or even a really heavy volume, I've seen that too, plus 200 or plus 250, it kind of gets your attention and, tells you to just stop, head back over to the news sites, look around, and try to figure out what the heck is going on. That way, you don't have to spend hours every morning scouring the headlines trying to find what could be coming at you today. We're still above the 10-week, still dancing around this zero gamma and volatility trigger, and we're dancing across the 10 here, right? So we got the 10-day and we got the 10-week, and that's what we're trapped against right here. We have a 310 cross starting. It hasn't happened yet, but it's starting. The first thing that you need for a 310 cross is for price to get underneath the 3 and underneath the 10. Check, we got that. The next thing we need is for the 3 to get underneath the 10. It was here, now it's here. If price can continue to move lower and get down there fast enough, then we'll drag that 3 through the 10 and we'll have a bear surge signal. Looking at it on the 5-minute doesn't really do it justice. Here's the daily. These are the moving averages that we're looking at. And there is the 3 starting to roll over. But we need price to expand below the 10 fast enough and far enough to drag that 3 through the 10. We don't have it yet. All of this is still just a complex topping pattern. We've been up here doing nothing all this time. So sure, we're starting these attempts to get out of the box, but we still ain't got it yet. That's a big piece that needs to be resolved. We still don't have it. So, sure, we're trending higher. We've got the higher lows, the higher highs. We're pushing against the upper edge of that box, but we're still stuck here. It's very possible for us to get a wash and they'll just unwind all of this, dump us down into 67 or 66, just scratch the whole thing and start over. Wouldn't be the first time. So we'll see if they're able to resolve this and get that breakout that actually sticks so that we can leg up into 7100 and just begin the next leg of this dance, or if they're going to end up having to wash it all off and start over. Getting below the 50 is going to be a big part of all of that. We were testing it multiple times this week, but that's not what we're looking for. We're talking about a clear, definitive breakdown below the 50. Below that, we got 68, 50, because we're running those 50s. We got this pivot point and then this pivot point and 67.50. We'll just run it. Big picture levels, level by level. 200 down here would be the ultimate goal if things got nasty. There's really no reason to believe that things would get that nasty. I think it would be more of some sort of macro shock, right? Some sort of flash crash shenanigans, similar to yesterday, right? That was just a very small taste of what I'm talking about. So this isn't some discussion of like the 2022 bear market where we spent months heading to the downside. I think it would be something a lot more swift than that. Something that got resolved and had us back to the upside by April at the latest, maybe mid-March. And that's if we actually start to break down and get nasty. It's all going to start with that 50. So if we get a clear, definitive break below the 50, just start running the levels. For us, futures traders running things on a day-to-day basis, it doesn't matter anyways, right? Because at the end of the day, for us, it's just another day from one target to the next. We have a market maker move this morning that is telling us that they're worried enough that they're applying additional hedges. They're always hedged, right? They're always hedged. This is extra hedging, and for them, it's pure cost. For you, me, maybe we can put hedges on and then we can trick it and really not have a lot of risk. We can limit our exposure. But for them, it is just like lighting money on fire. There is no recovery for that. They just spend it. Kind of like when you buy house insurance. You don't get your money back if your house doesn't burn down. They just keep your money. And you don't want your house to burn down just so you can collect the fire insurance, right? So you spend money for fire insurance on your house, hoping that you never get to use it. And it's just cost, right? Well, that's what they're doing here. They're adding extra protection. They're adding insurance in case something goes horribly wrong this morning. And we can see that. But at the same time, they're not sitting out. There's elevated volume showing that they're actively participating and they're hedging, which is a little odd. They don't normally do both. So we want to keep our eye on the market maker move this morning. It's not my opinion. I'm not guessing or assuming that they're hedging. I'm telling you for a fact, like the sun comes up and the moon will follow it on the way down. This is fact. They are hedging. If you want to see that for yourself, go over to the options tab. As long as you've got a broker that will show you the options on the futures, then you can see what I'm seeing. Otherwise, you would have to wait for the SPX to open, or maybe you could just use SPY early in the morning. On Thinkorswim, the creators of the Thinkorswim platform, they made this up, right? They are traders. The old team with Tom Sosnoff and the team, they are traders, and they made it up. So you won't find it on other platforms. But that doesn't mean you can't see it on other platforms. That's your market maker move signal. And all you have to do is look at the options chain with the implied volatility average. If the front average is greater than the next average out, you have a market maker move situation. Now you can learn more about that because there's articles from Schwab now that Schwab owns this. They've got an article, so you can just Google market maker move. And if you know how to use the internet's go back, then you could, go back a couple of years and get TD Ameritrade's articles on it. They had like 20 something articles, a whole lot of information about it. The new articles from Schwab, I think they have 2, maybe 3, a lot less coverage, but still it'll tell you what I told you. And they don't talk about the futures. They only talk about equities and earnings and binary events, but still it'll tell you about it. So we know they're hedging. We can see it. We want to keep our eye on that and see when it starts to go down. It only has a life for today, so no matter what, it will end by the end of the day because the contracts that they used won't exist after today, right? They're 0-day contracts. Looking at the ADR, we've already reached the edge of the ADR, and we did it early enough in the day that we can go to the other end by the end of the day. This isn't about bullishness or bearishness. It's just the way that price moves, right? So we don't have to go to the other side. It doesn't owe us that. But what we've seen in the past is if we get to one end early enough, there is time left in the day for price to go ahead and wander over there. It's what price does, right? If you look at the wave that price creates, it's just what it does. It doesn't travel in a straight line all the way down to this point. It came down and set a lower high and then lower lows and lower highs and then lower lows. So, wave form 101. If we get back below this ADR half, then we want to target the full ADR down here. We get through that, we would want to go ahead and target yesterday's low. Outside of that, we've got our 111 and 1236, and then it's just game on to the downside, right? Otherwise, holding above the ADR half gets us focused on the Globex high, get through that, and target the other end, 70.32 cog line. Now that would give us an inside day breakout, I think, or at least really close to it. Ooh, right on the line. So that's multiples, right? It's yesterday's high and it's the ADR half. That's going to be a difficult level to get through, but it'll also act a little bit like a magnet if we get close to it. So 69.92 cog line, we get that close, we're very likely to just come right on into it. Start working our way up through this level, right? To get through that, then we got 70.11 cog line, then the RTH high of yesterday, on up into the 70.32 cog line, level by level by level. Now you can run halves, you can measure out the quarters however you like, but that is the target if we stay above this lower ADR half. Today's floor pivot is lower than yesterday's floor pivot. That's bearish. Price opened above it. That's bullish. They kind of cancel each other out. Yesterday had a narrow channel. Narrow channels imply that if we break out, that it likely sticks and that we continue the breakout. You can see that we broke out yesterday and it stuck. We continued that breakout. Of course, we unwound most of it by the end of the day, but that's the idea behind the channels, right? The thing is, this channel doesn't make price breakout. It didn't cause us to break down. It didn't keep us continuing to move in a certain direction. It just provides insight on the idea of should we expect some sort of breakout or breakdown or not. Today's channel is much wider than yesterday. Wide channels imply that if we break out, it likely doesn't stick and we come back in again. Just to be clear, what we're talking about breaking out of is yesterday's range, and it's a very large range. One of the things about making big moves like we did yesterday is that it leaves this really big bar behind us. Now we're stuck inside day inside of this very big bar. Not just the ES either, right? Markets tend to do what the S&P does. So plus 70% of the broader market now has this really big bar and it's stuck inside it. So we're looking for an inside day breakout of a really big bar. And we're near the middle of that bar. So we're going to spend a lot of our energy and time just working to get to the edge, let alone actually get that breakout. So the base case argument today is if we even do get to the edge, I'm looking for a 111 reversal or a 1236 reversal, and I'm looking to see it come back in again. Unless we approach the edge at a velocity that I can't see at this point, I have no reason to think that we would continue a breakout today. So that's the reversal, 70.43 or 70.60. I call it yesterday's 111, even though we couldn't reverse on the 1236. It's just the name of the strategy, right? Yesterday's 111 is the strategy. So I don't care either side. If we break out, if we break down, we've got the levels, and you can see the midpoint. That is the real midpoint, not just the RTH midpoint. I did that because, well, the RTH mid is really so close to this mid that you might as well just pick one. and I would rather pick the whole thing if I'm going to have to pick one. It does line up at the bottom of our floor pivot channel, so you don't need to keep the drawing on there. You can just turn the drawing off unless or until we get near the edges, and then turn it back on. That way you know where the 111 is at. Because we expanded a long way yesterday, our S&R lines today are going to be a long ways off. As you can see with the upside here, this is R1, way up there. That's not really helpful. S1 is a lot closer. It's right there. Now, hopefully you can see the difference between these two. And I mentioned yesterday how the indicator will often give you some clues as to direction. This is showing that the range to the upside is much wider than the range to the downside, implying path of least resistance. It's more likely that we go up than down. That's just a mathematical formula, though, right? The probabilities are only based within the math that it defined from yesterday's price action. It's not like that indicator is looking at macro events and options flows, and you know what I mean? It's just a blind tool running math on yesterday's pivots. So just because it says we're more likely to go up than down today, don't put too much weight into that. It's just math. We do have the idea of S1 R2. R2 would be really extreme. That would be 7,100 today, and there's no reason to think we're going to get that. But we got close enough to S1 that we could call it, right? Hand grenades and horseshoes there. We're back to the floor pivot. So if we can cut through the floor pivot and get out of the channel, at the very least, it owes us R1. So we'd be looking for that inside day breakout, 111, 1236 reversal against R1. I'll take it. The problem is we rejected it and we didn't get through the floor pivot. So that's what we got to keep our eye on at this point. All right, the distribution for the week, it's not quite the old classic, but it's good enough. It looks a lot like this week back here, just looking at the profile, right? So we got a lot of work in at that 70-11 zone, a lot of structure up there. It's going to be really difficult to get through that. We would need a significant trigger, right? Otherwise, just grinding our way back up, we could eventually get through there in a couple of days. Start getting into next week's flow, just grind our way up through there. Trying to get there today in a single shot, just a significant boost in flows, it's really hard to see it at this point. So I'm not saying it can't happen, just why would it happen? We do have some economic stuff on the table this morning, but really, PPI, right? Really, I mean, is that going to be enough? It's possible. We don't want to say that it can't happen because we know price can do whatever the hell it wants. I just don't see it as very probable yet. The big first speed bump is basically the 92, so 69.92 cog line and then 70.11 cog line. Those two are going to be your biggest road bumps, speed bumps to the upside for today's drive. For next week, we'll just worry about next week when it gets here. That's That's good advice. Thank you. You know, a long time ago, I used to have the comments on for my videos, and there are bots that just go around making strange comments all over YouTube, and so I ended up turning them off. But you're right, I do need to turn those back on so people can make comments on the videos. Yeah, I forgot all about that. Thank you, sir or ma'am. 10-day, 30-minute volume profile with TPO. The point of controller lined up, but that's about it. The discrepancy ends there, right? TPO doesn't look that bad, but the volume profile is just nasty. We don't have anything here, and it's likely that the point of control gets shifted up into this 82 zone, but I have my doubts because we're going to continue to wipe those candles out through the day today. And if we take these candles out, that might be enough to remove this volume shelf. So then the default position is likely to be way up here, and that's going to be a cap on price at that point. And it's likely to be up there for a good 2 weeks or more, unless we can sit in one spot long enough to move it somewhere else. So 70-20-ish, 70-18 is very likely where the point of control is going to end up. For now, though, it's underneath us. We're going to take advantage of that as much as possible and try to get that push to the upside. See if we're able to keep it or not. So 69.40, this lower point of control, is kind of our last line of defense. Then we fall out of the value area and we start testing that 68.50 and 68.11 cog line and on down. I had somebody asking, was there any way that we could have seen this coming, right? Was there any data or charts or analysis that would have warned us that we were going to have such a significant move yesterday? And no, I mean, I don't know anything that would have anticipated that, but we had enough warnings that there was a lot of bad things going this week, right? Government shutdown being the biggest one. It's not like we didn't know that we were really close to a government shutdown. And that one thing right there was enough to have made me dial back my positioning. Because what do you think's going to happen when we get a government shutdown, right? But I mean, that wasn't what caused that. But we have a lot of things at risk right now. And I warned multiple times this week, know what you own, be very careful, because we're getting into a bad spot. And if this market sells off, it's going to be violent. So are we done? I don't know. You don't know. Nobody knows. We have to see if the market can pull it back out or not, right? This is the 5x5. We don't have a new VPOC from yesterday, so nothing to mark there. Somebody asked me if VPOC is volume profile point of control. No, it is virgin point of control, untouched. This is a volume profile. I don't need to put the V on there to tell you that it's the profile from the volume profile, right? Why would I do that? No. So the V does not stand for volume because it is a volume profile. It's just the point of control. And if it hasn't been hit, like this one down here, then we call it a VPOC. That's it. I didn't name it, by the way. It was already named VPOC. So if it's a volume profile, you don't have to put the V on there. We all already stand that it's a volume profile. We don't have a VPOC for today, and we don't have any discrepancy between the TPO and the volume profile. They are not giving us anything of value or insight at this point. And now we have next week's range. The thing about next week's range is this is just a preview. We won't know what it looks like until we come in next week. But on Friday every week, I like to do this, get an idea of what the market is pricing in. See, the width of this range is based on money that is placed in next week's trades. All right. So they can go on TV and run their mouth and say whatever they want, but follow the money. If they think that next week is going to be wide, that's what they trade. And if they think it's going to be a hurry up and wait, sit on your hands, don't do anything week, then that's what they trade. We'll end up with a narrow range. We can use that, not to say that, they can't get it wrong, because oh boy, they can get it wrong. But there's billions and billions of dollars placed around these weekly levels. If they have the conviction to put the money in, then at the bare minimum, I want to take a look at what they're doing. So we can compare next week's range to our current week's range and kind of get a feel for what are they thinking about next week. There's two ingredients that go into this range. One is, well, how many days do we have next week? And then the other piece is, how much volatility do we have next week? This is a 5-day week. Next week is a 5-day week. So that's the same, which means if there's a difference in the size, it must be based on volatility. So this is next week's range. Notice I'm not zooming in and getting it to the tick perfect, right? Like some weird Canadian engineer. Just ballpark it, it's good enough. And we can see that next week's range just a little bit bigger than this week's range. So there's a little bit more volatility being priced in for next week than this week. And that makes sense because this week was an FOMC week, which is usually a volatility suppressing week. What do we have next week that would be volatility suppressing, that is big enough to come even remotely close to an FOMC week? That will be the thing that we would want to answer, right? At the moment, next week does not look like a hurry up and wait week. So we don't want to run iron condors and things like that. Could run like the double diagonal that I've talked about before, just because it'll give you break-even edges that are wider than the entire week. But probably would be better off not trying to play the edges. That also means for next week that we could get some inside day breakouts that stick, right? And that we keep the breakout. If it was a really narrow week, like say back here on this FOMC event, that was a really narrow week, then we'd have a better idea of what to expect, right? You can see the difference. So if it was really narrow, we'd be able to see it, and it's not. But it didn't hurt to look, and we'll look at it again on Monday, because at some point today, it can change. It's still moving, it's still alive, and it won't lock until after the close today. Looking at where we're at with the 10-day, we're underneath it. We've been making these little soares below the 10 where they don't stick. We just get little one-day wonders and we're back again. It's possible that that's what we end up with, but be mindful. They can get a little out of control, right? And it can last. It doesn't have to be a one-day wonder. So keep your eye on the 10. As long as we're within 0.5% of the 10, either above or below, then it's a little bit of an imaginary collar. Options prices tend to calm down a little bit within this zone. Volatility is lower. The movement of the price of the option is calmer. Then we get outside of that range and things tend to change a little bit. Anywhere within this 1% boundary above and below, and things are okay. We're not out of control yet. We get outside of that to the downside, things are going to get pretty ugly really fast. Zoom out and look at where 1% is. You can see the line that my mouse makes. We get below 1%, and sometimes we hold below 1%. But that's, if you look at the dates of when that sort of behavior happens, they line up with bad economic news or events that last for a while. It's not just random price that takes us down that deep. So if we're going to get below -1, more than 1% away from the 10-day to the downside, then it's going to need to be a macro headline that shocks the market and keeps us off balance to continue that drive to the downside. There's nothing on the schedule at the moment that could provide that sort of impact. So not looking for this negative market backdrop to stick unless we start getting some other data that we don't have yet. We're still above the 10-week, but we're less than 1%. That starts getting us into a little bit of gravity. If you get too close to the 10-week, you're liable to just get drawn right on into it. But we are still above it, so that keeps us in a healthy backdrop. Even if we were to get underneath it for a short period of time, like we did back here, then it's likely just a one and done. A little bit of a retrace before continuing to the upside. I'm still looking for a break over here, right? We've been setting these lower highs. At some point, we're going to get that crossover. And it's likely going to come after a deeper drop, right? You know, if I kind of zoom out here, some of the taller upside moves came after getting deeper downside moves because reciprocation, right? The main thing is if we're above the 10-week, we still have a positive market backdrop. So I wouldn't get too bared up. Looking at what's down in the overnight, we got gold miners, precious metals, uranium. The Mag 7 up volume is down. Bitcoin, China, more Bitcoin. Solar, chips, China again. Nat gas, emerging markets. Yeah, just about everything, right? Financials are down. They're just not down enough. The benchmark we use is 0.5%, so they got a ways to go. And that's generic finance too, right? Look at something like banks, they're barely down at all. But from a market breadth perspective, um, we don't have any sector that we would use for a breakout rally day. We don't have any of them. 50% of the NASDAQ 100 is down at least 0.5%. And when we look in there, we want to see, well, what names necessarily? Looks like all of the semiconductor names, a couple of railroads, but you know, who cares about railroads? Packaged software, some medical specialty. Then the Mag 7s. So yeah, with those names, no way we're getting a breakout rally day unless those turn around. The thing is, they can just stop falling. That would be good enough. And then we could get some 0-day flows from the dealers. We could get a breakout and a rally. It'd be a forced grind buy higher, but it could happen, but these would still need to stop falling. They don't necessarily need to run, but they would need to stop the decline. 33% of the S&P 100 is down at least 0.5%, so not as negative as the Nasdaq. And of course, you got the chips down, some banks, and the Mag 7, some more finance. We'd really want to see the finance get turned around a little bit too, right? We've had that discrepancy a couple of times this week. If they work together, things tend to turn out a little bit better, right? So this is KRE on the left with mags here in the middle. When they do the same thing, we tend to have better outcomes. So from a breadth perspective, we don't have it. Looking at what's up this morning, nothing. We got nothing. The VIX is up. Yeah, that's it. That's the only thing we got. All right, get back below 17. I mean, I'd like to say 17 and a half because of that weekly floor pivot, but I don't think that's going to be good enough. I think we could start with that, I guess. Get below 17 and a half and then get below that 17. We don't need the VIX to completely unwind because that's just unrealistic for a single day's play, but we want to see a continued shade to the downside. 17 and a half is a good place to start. What we don't want is sweeping moves back up. So if this thing can just stop with the upside moves, maybe just hang out and not really do anything at all, that might give the S&P some cover because we're holding underneath 18. That was a good start, but it's not enough, right? We want to get further to the downside than that, preferably back below that weekly pivot. And I think 17 would be better. If we get below 17, we could see the ES and the NASDAQ make some sweeping moves to the upside. But if this just stalls out like it did right here and we just hang out in that sort of regime for the rest of the day, I don't think that's going to be enough. I think it's going to have to actually give us something. So, all things considered, this isn't one of the best setups on the week. We've had days this week that were much better, but it always is a get out of the box situation. This is the box, so GTFO, right? Get out of this, and we focus on level by level. Start with the Globex on the upside, then the RTH open, the high, the full high of yesterday, and then we'll work it out level by level to the upside. Or get back through VWAP, break the Globex low, get through the weekly pivot, and we'll head to the downside level by level. It's just not an ideal situation because of how big yesterday was. And it's very likely that we stay inside of yesterday's range and digest for a while because it's such a big bar. We'll just have to see how it all plays out. So what I got for you guys, be careful, be safe, have a good weekend. I'll see y'all next week.